Hello, fellow rebel capitalists. Hope you're well. Breaking news: stock market down huge. Excuse me, about 600 points right now. It was down 1,100 points earlier. We're going to go over an article from CNBC that outlines this and get some thoughts from one of my favorite OGs, and that is Jim Chanos. But it looks like the Fed may be in this position where a lot of us known they'd get to, or a lot of us have assumed they would get to eventually, where they really can't continue to decrease interest rates. They can't do any more quantitative easing. Uh, the We're in this inflationary environment, but we're in a inflationary recession. So, from a political standpoint, you can imagine the phone call with the administration and Jerome Powell saying, "Well, you can't." Uh, you can't save the market. You can't continue to print money because if inflation runs hot, then I'm not going to get reelected. And then Jerome Powell answers back with, well, if I don't save the market, you're not going to get reelected. So pick your poison, my friend. I think that maybe the Fed was hoping, between the Fed and the administration, that this talk of tapering and gradually reducing the amount of quantitative easing and that going into potential interest rate hikes would just kind of have the market go down slightly, just gradually. They like things to happen in an orderly fashion. And if the market goes down by, let's say, 20% over the next year in kind of an orderly fashion, or as orderly as possible, then that could bring down the rates of inflation. And you got to remember, they're Keynesians. So they're completely locked in on the demand side of the equation. They understand that there's a supply component to it, but that's really not part of their, well, I don't know if it's part of their models because I've never seen their models. I don't know their formulas. I've never even opened an economic textbook. So I don't know what their models say, but from what I've heard and what their actions, it would imply that they really don't pay attention to the supply side of the equation at all. So, and the reason I say that is because yes, you can bring down aggregate demand, but prices can still go up if the supply of goods and services is going down even faster. You guys know that from watching my videos. So let's get into the article and then try to think through the position the Fed is in and what they may do in the next couple months, or what they may say in the Fed meeting. I believe it's this Wednesday. And we'll do this one. I think that'll work for this article. Josh is still on a plane coming back from the protests in DC. He had to take a later flight. All right, Jim Chanos says the notion the Fed will be able to bail out the stock market is dangerous. So the idea the Fed is always going to be there is a bad investment decision, is really not cogent. It's a bad, let's see, how is he saying this here? Sorry about that, guys. Don't have my glasses on. The idea of a Fed put, and the Fed is always going to be there to bail out my bad investment decisions, is really not cogent investment policy to hold on to for a long time. Although I would say, and Jim, it has worked since 2008, but again, that doesn't mean that it's a solid investment strategy long term. And that's what we've always said. You can't just sit there and say, well, I think the price is going up, or I think the price is going down, or trying to time the market. That's why I say that until I'm blue in the face, that you just buy things when they're cheap and sell them when they're expensive, and just let the chips fall where they may. And you're going to miss out on huge gains. Yep. And you're going to be able to miss out on opportunities where you could have bought XYZ asset a lot lower. Yep. That's very true. But if you just sell things when they're cheap and buy them when they're expensive and just do that over the long run, you're going to have a mathematical edge and you're going to come out ahead. Market sell-off accelerated Monday with Dow dropping, and I want to say market sell-off. So guys, if you haven't been watching my videos, let's go back to when the Fed started talking about tapering in November of 2021, so a few months ago. And since that time, the Dow is down significantly. It's gone kind of up, it's gone down, back up, then crashed again. But it just shows us that the Fed's balance sheet matters to the stock market, whether it's psychological or whatever the reason is, and I would argue that it is more psychological, but the Fed just talking about decreasing the size of their balance sheet makes the market, in my opinion, really sell off. And one thing the Fed doesn't consider, nor do the politicians or a lot of the economists or really the market, is the fact that the Fed's balance sheet, even if it's not a even if it doesn't have a direct causal effect with the stock market, even if it is psychological, people and the market become dependent upon the Fed's balance sheet increasing, just like they become dependent on money printing, government deficit spending, etc. It's just monetary drug. It's like heroin. So if we go back to 2018 and they say, well, we had a taper tantrum back there, but it took, let's say, 6 months for it to play out, where the Fed got its balance sheet to a point where the market said, okay, no more, no more, no more. You can't assume that because that happened in 2018, it's going to happen the same way this time. The amount of time most likely would be dramatically reduced. Why? Because the market is far more dependent now on the perception of monetary heroin than it was back in 2018. And the real economy is definitely more dependent upon government spending than it was in 2018. So it's not surprising that the time horizon compresses substantially. So then now that we understand kind of what's happened since November, a little backstory there with the Fed reducing the size of its balance sheet, i.e. QT, let's go into this quantitative tightening. The market sell-off accelerated Monday with the Dow dropping as much as 1,100 points as investors braced for a potentially hawkish tilt from the Fed this week. S&P 500 also dipped into correction territory, falling more than 10% from its record high. The Fed will wrap up its policy meeting on Wednesday. Central bankers have indicated they expect not only to raise rates and taper asset purchases soon. They expect not only to raise rates and taper asset purchases, okay, I get it, but also could be teeing up the balance sheet reduction. That's a quantitative tightening we talked about before. The potential move from the Fed would mark an aggressive policy change after nearly 2 years of the most accommodative monetary policy in U.S. history. That's what I was talking about. You can't keep just giving the drug addict more and more and more of the drug and just assume that their body isn't going to become acclimated to it. And their body isn't going to become addicted to the higher dosage. And that's exactly what we've seen with the Fed's balance sheet. And it's exactly what we've seen with government deficit spending in the real economy. And I'm sure they're kind of tied at the hip, but I don't want to get into that detail with this video. So now let's think about what position the Fed's in. We started talking about that at the top of the video. And they've got Jerome Powell screaming at them to do something to control inflation, because inflation, consumer price inflation, is just the kryptonite that all politicians fear, especially at a federal level. So you can imagine all the administration little yes men and yes women telling Joe Biden or whomever's in charge that, hey, listen, if the CPI continues to stay at 7, or if it's going up, you're not going to get reelected. There's no way. And the other Democrats are going to have a very difficult time in the elections coming up here, the midterm elections. So then he gets on the phone with Jerome Powell, like we said, and Jerome Powell says, hey, if you want me to stand back and do nothing, then the stock market's going to crash. So then the question becomes, okay, is it the disorderly down 20? We're already down 10%, and that happened rather disorderly, I would say, from the Fed's point of view. So do we have another 10% down in a disorderly fashion? I think it really depends on what they say Wednesday. And Wednesday's a very, very important Fed meeting, because if they continue, I think the market is kind of testing them right now. where the market's saying, okay, Fed, we're going to call your bluff. We're tanking here. We're going to sell off and we're going to listen to what you say Wednesday. And we're tanking because, and why do I say they're calling their bluff? Because I think they're really trying to determine whether the Fed is really serious about what they're saying as far as quantitative tightening, raising interest rates 3 or 4 times this year, or they're just kind of jawboning the market. Which is it? And if the Fed comes out still hawkish on Wednesday, man, or if the market perceives their comments as hawkish or just as or more hawkish, boy, I think you could see the market the market really sell off then. And but let's think about this. If the Fed comes back and says, well, we understand the market's down, we're going to pay attention to it. The plan as of right now is still 3 rate hikes, quantitative tightening, but we're going to be data dependent. Let's say they kind of give a dovish dog whistle or kind of some sort of dovish signal that the market perceives as dovish. Well, then you could see the market rip back because they're saying, okay, yeah, Fed, we called your bluff. We didn't think you were really going to do it. We thought we were just jawboning the market. The question then becomes what happens to the dollar? Because if the market sniffs out the Fed doing a 180 because they're beholden to the market, what on earth does the dollar do? And then how does that affect consumer price inflation? What does gold do? What do the gold miners do? Um, I mean, and then you could imagine a scenario where all of these growth stocks that have just gotten smoked the last couple weeks could have a significant turnaround. So usually I'm not interested, or I'm not that interested in the Fed minutes, what they're saying and kind of their statement from the Fed meeting. But this is one that I think we should all pay a lot of attention to because we could see some serious volatility in the market in during this week. And so that's kind of what I wanted to go over with this video. And the Fed is just really in a difficult position. And I think one more thing we should think through, just more macro, is if the CPI continues to kind of levitate. You could imagine if they get this slow decline in the stock market, and if the CPI starts to go down, that's going to give them a lot of cover to reverse course. If they can get the CPI from 7 to 6, maybe to 5, and then say, okay, well, it's coming down, it's trending down. We see the yield curve flattening, so we're going to go ahead and take a more dovish stance. This is going to support the stock market. That's one scenario that could play out, and I think that's what they're hoping for. But if you see this downturn in the market, especially a disorderly downturn, and if inflation doesn't come back down and starts going and it even goes up further, man, that's kind of the come to church moment that we have all been talking about for such a long time that we knew the Fed would eventually get to, because we know there's no free lunch. At some point, you got to pay the fiddler. But and the point and the situation I'm referring to is the Fed. They're impotent. That's what I said on Twitter. They can't do anything because they can't their only tool, as you guys know, is just printing money or creating bank reserves. We'll call it that. So they can just print all the bank reserves they want, and or in this scenario, they can't because the market perceives that as inflationary. More importantly, the administration sees that as inflationary. Just think back to the 1970s and how politically unpalatable it would have been for the Fed to drop interest rates and start doing quantitative easing. I mean, there's just no way. There's no way that, I mean, wow. We're just headed. This is fascinating. You can for a macro person or someone that's really interested in macro. Uh, this we've I think we're gonna have a lot to talk about in the next few weeks and in the next few months. So takeaways here: market has been incredibly volatile to the downside. Let's watch what the Fed says on Wednesday, if that's their meeting when they're going to release a statement. Let's see if it's hawkish or if it's dovish. If it's hawkish, I would look for more downside volatility. If it's dovish, you could see a quick snapback correction. But then you got to look at what happens to gold. You got to look at what happens to the dollar. And then we've really got to pay attention to what's happening with that CPI print, because that's going to either give the Fed the red light or the green light from a political standpoint. Remember, to answer in today's day and age, to answer economic questions, we have to first start by answering political questions. All right, guys, enjoy the rest of your afternoon. Make sure that you're always standing up for freedom, liberty, free market, capitalism. We'll see you in the next video.